Hello everyone, welcome back to lesson 3. And in this lesson, we're going to be focusing on liquidity sweeps. If you have not yet joined our Discord, please do. We're actually killing it, and we just want to help traders that are struggling, that have been fed misinformation, or haven't actually found something that actually works for them. Okay, so let's get into it. Let's say price has been unable to break a relevant high for some time. Okay? So many traders will think if price goes above this high, I'll buy. Others who are shorts place the stop losses above that high, and as a result, a large pool of liquidity of orders will form above that relevant high. So when price finally pushes above it, all those stop orders and breakout orders get triggered, and this is called a liquidity sweep or a stop run. Okay, so when I was backtesting this model, I came to realize that the 4-hour highs and lows were very efficient because when one is swept, price is usually overextended. And with this entry model, you can grab a 2R even if price wants to trade in the opposite direction in the long run. What I usually do in this model is I place my stops at VE after 1R, but I have found that I'm most profitable when, even if I take a couple of break evens, if I let the trade actually run to 2R. So, but I'll explain that in the entry models video when I provide examples. So what we need to watch after the sweep is the reaction and not the sweep itself. So we also need to make sure that there are no clear relevant highs close to the 4-hour sweep. If not, we can expect the market to take those before actually creating some sort of reversal or large pullback. Okay, so let me tell you why price often reacts after sweeping the 4-hour highs or lows. So as I explained before, we think of the sweep as market collecting orders. So once price reaches the liquidity pool, stop losses get triggered, breakout traders enter, and the big boys of the market grab enough orders to fill in large positions. So after these orders are filled, there's often less reason for price to keep moving aggressively in the same direction immediately. So price tends to pull back to rebalance inefficiencies or returns to the fair value area. So this usually creates a retracement, be it to the value area of the volume profile that I explained on my previous video, or a higher time frame fair value gap, and this is where we look to take advantage and grab our piece of the pie. So we don't need to grab the whole move. We're just looking to grab a 2R. If the market gives you more, you can take more. You can trail your stops, but that's something that's up to you. And I tend to target the value area high or the point of control. Again, I will provide you with examples, but you just need to see what works best for you and for your psychology. Okay, so I know you're probably wondering how I use all these concepts together, but I just don't want to cluster you with information in one video and make it a really long video. So in the last lesson, I will provide you with an entry model and examples on how to use everything together. I also have a flowchart of the exact entry criteria that you need to look out for, and that can help you indicate if there would be a trade or if it's not eligible for a trade. Okay, so see you in the next one.